let's talk about the one question that is absolutely dominating the conversation in tech and finance right now. It's this ghost from the past that everyone keeps bringing up. Is Nvidia, the king of the AI boom, just doomed to repeat the history of Cisco, the poster child of the dot-com bubble?
And it all kicks off with this picture. Seriously, this chart is what got the whole debate fired up. You've got Cisco's wild ride up to the year 2000, and right next to it, Nvidia's run today. I mean, look at them. The shape, that vertical climb, it's not just similar, it's kind of spooky. It's almost a perfect mirror.
And seeing that just forces you to ask the big, maybe uncomfortable question. Are we just watching a rerun of the year 2000? Is all this excitement and all this money pouring into AI just the prelude to the exact same kind of spectacular crash? Okay, to really get our heads around this, we're going to break it down. First, we'll get into the valuations, the price tags. Then, we'll jump into the moat debate, how well defended these businesses are. After that, we'll look at the world back then versus the world today, before we wrap it all up with the final bull versus bear case. All right, let's dive right into our first section, valuations. Because, let's be honest, whenever you're talking about a potential bubble, it always comes down to the price. Are we looking at something insane, or is it justified? So the first thing an Nvidia bull will tell you is this. Look at the price-to-earnings ratio. At its absolute peak, Cisco was trading at a mind-boggling 200 times its earnings. That's pure hype. Nvidia today, it's trading at around 50 times earnings. So from this point of view, Nvidia looks way more grounded in actual profits, not just future promises. And you might think, okay, case closed. But not so fast. The bears would say that PE is just one piece of the puzzle, and if you only look at that, you're missing the bigger picture. And this is where it gets really interesting. If you switch metrics and look at price to sales, basically what you're paying for every dollar of revenue, suddenly they look a lot alike. Cisco was around 40, Nvidia is around 30. Pretty close, right? The huge, glaring difference, though, is Nvidia's profitability. Their gross margins are over 70%. That is a cash printing machine in a way that Cisco frankly never was. So, the valuation story is complicated. What about the actual business? Let's talk about their competitive advantage, or what investors love to call an economic moat. So yeah, just a quick refresher for anybody who's not familiar. An economic moat is just a fancy way of describing a company's ability to keep its competitors at arm's length. It's the wall that protects the castle and all the profits inside. If you ask anyone who's bullish on Nvidia, they'll tell you this moat isn't just a moat. It's a chasm. It's deep, it's wide, and it's basically impossible for anyone to cross. But, of course, the skeptics see it very differently. They look at the same defenses and say, yeah, there's a moat, but I think I can see a few drawbridges. The argument for Nvidia's giant moat is really strong. You've got CUDA, their software, which is this incredible ecosystem that basically locks developers in. Then you've got their market share, which is just staggering, over 90%. And they're selling to the richest companies in the world who literally have to keep buying the newest, fastest chips to compete. But here's where the bears come back with a history lesson. They'll remind you that Cisco also had about 80% market share back in its heyday. Dominance is not a birthright, it can fade. Cisco's cutting-edge hardware eventually just became a commodity that anyone could make. And you better believe that competitors like AMD and even customers like Google are pouring billions into creating their own alternatives. No moat is uncrossable. Okay, let's zoom out for a second, because no company, no matter how great, exists in a bubble. The world of the year 2000 and the world of today are totally different places, and that context is everything. And this is maybe the single biggest difference. Cisco was selling its gear to tons of speculative dot-com startups, a lot of companies that were burning through cash with no real business plan. Remember Pets.com? When their funding dried up, Cisco's sales fell off a cliff. But Nvidia? They're selling to Microsoft, Amazon, Google, Meta, the most profitable companies in the history of capitalism. Their wallets are a lot deeper. And perhaps the most critical difference is just the cost of money. Back in the late 90s, the Federal Reserve saw all that speculative frenzy, and they started to pump the brakes by hiking interest rates again and again and again. By May of 2000, right at the peak of the bubble, rates hit 6.5%. That made money expensive, and it basically choked off the funding for all those speculative companies. The party was over.
Now, fast forward to today, the Fed funds rate is much, much lower. Money is just cheaper. And that makes it a whole lot easier for big tech companies to justify spending tens of billions of dollars every year on new AI chips.
Okay, we've looked at the price, the business, the world they operate in. Let's put it all together. What is the final, ultimate argument for the bulls and for the bears?
So the bull case is pretty straightforward. This time is different. They'll tell you Nvidia is just a better business. It's more profitable, its valuation is more reasonable, its moat, thanks to CUDA, is stronger. It's selling to stable giants in a world where money is still relatively cheap. You just can't compare the two.
But the bear case says don't be so naive. History doesn't repeat, but it often rhymes. The price-to-sales numbers are eerily close. The story is identical. They're selling the picks and shovels in a gold rush. And here's the absolute killer argument. Cisco's business actually did great for the next 20 years. But its stock? The stock has never, not once, gotten back to its 2000 high. The company can thrive, and early investors can still lose.
So there you have it. The case for, the case against. The data points that look scarily similar and the ones that look worlds apart. Where does that leave us? And that leads to maybe the most provocative thought I've seen. What if the comparison to Cisco is totally right, but the timing's all wrong? What if this isn't the peak of the bubble, like the year 2000? What if it's more like 1997, and the craziest, most speculative part of the boom is still to come?
Ultimately, looking at Nvidia through the lens of Cisco isn't about getting a crystal ball to predict the future. It's about using history to arm ourselves with better questions. It helps us see the risks, gut check the hype, and really dig into what makes this moment in technology so unique. It's not about finding the answer, it's about being smart enough to ask the right questions.